What's up, everybody? It is Monday. Yeah, March 21st. Is today the first day of spring? Either today or tomorrow, I don't know. But it was a beautiful day here in New York City anyway. All right. We had a little pullback in the market today on some comments by Powell. Headline trading. Everybody went crazy because he came out kind of aggressive in his tone, talking about a 50 basis point hike at the May meeting. Let me just tell you something, that the 50 basis points, that was already priced in. If you look at Fed fund futures, there was already a 50 basis point hike priced in. So, you know, whoever reacted today, they really are not focused or are not aware of the situation that the market has already priced that in. But again, I'll repeat, I really don't spend a lot of time paying attention to monetary policy. I don't spend a lot of time paying attention to statements from Fed officials. It's really, to me, it is just a psychosis, as I've said many times. I mean, the insane focus on monetary policy is a kind of a mental illness, and that's all everybody pays attention to. I mean, nobody's talking about fiscal, nobody's talking about bank credit, which is surging. I mean, if you look at the numbers, the most recent numbers from the Fed's weekly release, I mean, you got loans blowing through the roof, bank credit surging up, you know, loans in every category, from commercial and industrial loans, real estate loans, residential real estate loans, commercial real estate loans, consumer loans, credit card loans, automobile loans. I mean, they're all just blowing right through the roof. So where the economy maybe was a little bit vulnerable because of the pullback in fiscal, and fiscal is not that bad either. I've been telling you guys, we'll come in close to 600 billion, you know, 550, 600 billion for the month. That, you know, we were talking anywhere 30, 40, 50% higher than the pre-pandemic fiscal support that the economy had. And that was perfectly fine for the stock market. So we should have no problem. But now on top of that, we're seeing loan growth like we haven't seen basically since before the pandemic. And in some segments, we're seeing loan growth hit record levels. I mean, automobile loans, record levels. So that's a very positive thing. Now, you know, I've said this before, loans are not the same thing as fiscal support. I mean, you get a Social Security check, or you get a tax refund, or if you just get a check from the government as part of a stimulus or an unemployment check. I mean, that's yours to keep. That's money in your pocket that goes in your bank. Loans have to be paid back. I understand that. The Fed is raising interest rates. Interest rates are still historically low. And debt service burdens, household debt service burdens, that's, you know, what it takes to make your monthly nut every month. I mean, that is still historically low. The other thing we saw was, okay, today oil was up, and I said in my last video, you know, that's going to be a feature. I mean, you know, there's no getting around it, that the sanctions are going to have a constraining effect, a constricting effect on oil flows, and we're going to see higher prices. But one thing that was evident last week in the EIA weekly petroleum status report, you know, I cover that thing every week, there was like zero impact to gasoline demand. Zero impact. I mean, I think it was down like something ridiculous, like 18,000 barrels per day, 18,000 barrels per day less in demand. When you're talking about like 9 million barrels a day in gasoline demand, I mean, that's literally, you know, that's a rounding error. It's nothing. All right. And that took into account a big surge in prices. So far at least, there hasn't been any significant impact to gasoline demand. And again, let's go back to what I was talking about a couple of weeks ago with the increase in oil prices. You know, it's going to take, I think I said in a prior video that it's going to take over $150 a barrel oil to have a negative impact on the economy that will push us into a recession. I mean, now we're at what, 109, 110. The economy can handle that. So here's the thing. You got good fiscal. You got bank credit, very strong. Loans, you know, surging right now. Bank assets are at a record high. Bank residual, that's assets minus liabilities, it's literally bank capital, and that's bank capital is really the only constraint on bank lending. That's going back up. We're at a 3-month high on bank capital. I keep saying, like, these bank stocks are so undervalued. I mean, they got hit really, really hard. I mean, for good reason, because the war and the sanctions. Banks had to mark down value of their assets because of the potential or the likelihood of default. And so that happened. I mean, I've been talking about this. We saw almost a 160 billion decline in that bank residual. And that, like I've been saying, represents more than 5 trillion lost in asset capacity. I mean, that is a big haircut. Are you talking about almost roughly equal to what we saw during the COVID pandemic, the full-blown pandemic when everything was shut down globally, the economies was shut down. So, you know, I think the banks have, at least up until now, what we know of the sanctions, the bank stocks have discounted the negative impact from that. And the good news is that bank residual, that bank capital is starting to go back up again. And that's the real lending power. That is the real lending power. I was watching a video the other day, somebody talking about how, you know, the yield curve is inverted, and inverted yield curves have this kind of perfect forecast track record of forecasting recessions from 1 to 3 years from now. I mean, is that really useful information? Number one, I'm going to ask you that question. Number two, I think people who make that correlation, I mean, to me, that's a very spurious correlation. I mean, if you're saying like the yield curve is inverted right now, and I remember we can go back 2019, the yield curve was inverted and everybody was like freaking out over that. We're 3 years on, okay? We're not in a recession yet. I think a lot of people draw these conclusions, and the correlation is very suspect. And they're talking. One guy was talking about how, oh well, now the banks are going to stop lending because, you know, if the yield curve is inverted and the banks borrow short and lend long, they don't borrow short and lend long. Okay? Banks create money by virtue of making loans. Loans create deposits. All right? They don't take your money and turn around and lend it out. That is a pervasive fallacy that everybody thinks, you know, we're living in this world of the Bailey Building and Loan, you know, It's a Wonderful Life with Jimmy Stewart, where they take your money and they lend it back out. No, the money sits there. Part of it goes to reserves, which they're required to hold. But the money sits there, and the very act of making loans creates deposits. And the bank will price a loan so that it will have a profit. they're not going out looking for money and then turning around and lending it out. So that is a complete fallacy. Banking does not work that way. It just does not work that way. But the good news is a lot of people think that it does work that way. And so I think they're going to miss out on this rally, because they're either going to be sitting on the sidelines or they're going to be shorting this market because the yield curve is inverted, thinking that, a year or 3 years from now, there's going to be a recession. I mean, to me, that's useless information. That is completely useless information. Now, there may very well be a recession if, again, we see oil prices go above 150. And by the way, Q1, I think I mentioned this, first quarter growth is going to be very weak. I mean, we're barely going to be in growth territory. I think right now the forecast is for something like 0.5%, 0.5% GDP growth. But I said in my last video, that's going to be most likely that will be the trough, the low point for this year. And I also suspect that number, when we end up seeing that number at the end of April, we'll get the first estimate of first quarter GDP. I think it's going to be higher than that anyway. Because, again, we got very strong loan growth. And that, to me, suggests a strong economy. I mean, banks make loans to people or firms who can afford to pay those loans. When you go into a bank and you ask for a loan, what are they going to want to see? They're going to want to see your income. They're going to want to see your liabilities. In other words, your ability to pay back that loan. And so if loan growth is surging right now, it's obvious that banks are assessing the situation or see the situation with their customers as one which is very positive, very healthy, where they can make those loans. So, I mean, that is just an indication. Strong credit demand, to me, is an indication of a strong economy. When the economy is weak, when you're in a recession, you're going to see loan growth go way down. In fact, you could even see a contraction. That is not the case right now. It is the opposite. So I think you need to pay attention to that, as opposed to all these other people running around like chickens with their heads cut off because Powell said, hey, I'm going to hike 50 basis points. That was already in the market. That was already in the market. If you want to see what the market is pricing in, the CME has a great tool. You can access it online. It's called the Fed Watch tool, FEDWATCH tool. If you just Google that, it'll show you the probabilities for every single Fed meeting from now until, I believe, July 2023. What is the probability, that we're going to be 50 basis point, 50 to 75, 75 to 100, 100 to 125. It'll show you right there. And that is what the market is expecting. So when he says, hey, I think we're going to go 50 basis points, that was already priced in. So people freaking out today based on those comments, I mean, they don't know what they're doing. Those are very unsophisticated players. And how many times have I said, if you want to make money, if you want the easiest way to make money, go against the unsophisticated players. And just have a little patience and don't overexpose yourself, and you're going to make money. And today was another example of the unsophisticated investors, freaking out because Powell said something that was already priced into the market. Anyway, that's it for this video. If you want a copy of today's Monday, so I sent out the new issue of MMT Trader. If you want to get a copy of that, go to my website. If you want to talk to me about an individual subscription, send me an email at mnorman@pitbulleconomics.com. Bye for now. Bye.